Welcome everybody to the Boom and Bust meeting number 32. We're going to talk about option convexity and market outlook. There is myself and Professor Nuria Rubini. As you all know, all those Zoom meetings are for educational purposes and also to fill the gap between Wall Street and Main Street for you to become better investors. Although we have a lot of institutional investors also following our boom and bust signal. I've prepared a presentation which I would like to share. So option convexity and market outlook. You will be able to review all the past videos of all of these Zoom conferences on our website under top videos. There is a free section and also a section for paying members only. We also have a YouTube channel, and the videos can be also reviewed on Bloomberg. We have an app on Bloomberg under Apps Boom Go, and you will also be able to see all the top videos. So before we explain how we performed 650% in August and September with our put option by being long of a put option, we need to take a step back and understand, first of all, how our signal works, our macro overlay, and then introduce new concepts as the world is changing, and there is a big paradigm change that has happened in 2020 and 21 and 22 with inflation, slow growth, and obviously the war in Ukraine. So our signal is based on a concept which is called risk asymmetry. And on top of the risk asymmetry in our algo, we have a macro overlay. So both the risk asymmetry algo and the macro overlay is for you to recognize risk, which is very important. Sometimes when people are pointing at risk, they are perceived as bearish. I think that more than bearish, you have to try to be realistic, and smart people do recognize risk. They know how to manage risk, how to control risk, and therefore to take the risk into their advantage without having to be bearish or all the time and so on. So the macro overlay will help you to understand risk, and the risk asymmetry not only recognizing risk, but will help you to control. So why is it so important that our algo is based on risk asymmetry? Because you want to try to achieve a higher return with less risk. Therefore, you want to be able to invest in a favorable setting where when you see a red boom, you want to be more defensive, reduce exposure, and obviously lose less money. And when you see a green bust, you want to be more aggressive, increase exposure, and make more money. In the I have this slide as a cartoon. So basically a green bust is when you have to perceive the market as a shop where there are sales. So if stocks are cheap and they're down, and we're talking about a $1 trillion asset class that like the S&P, given historical return, you have a green bust and you want to take advantage of the green bust. While on the other hand, if the stock market is very expensive, is then that you want to sell and exit the room in time. You want to be the first one to sell, and the red boom will allow you to do that. So what has happened this year? So the stock market has gone down. We had this is the chart of the S&P. We had a few on the way down. We had a few oversold signal, the blue circle here in this graph in May and June. They all performed 5 to 10%. But in June, there was a rally that actually on the S&P where the market went up about 18%. And so I was trying to understand what to do next, and uh, um, and whether our boom and bust signal would have been of any help to whether continue riding the rally after an 18% upward move, or whether to reduce exposure. The signal, because of how the market and volatility was trading, we didn't have any signals. The algo did not produce any signal. I remember being in August, a lot of subscribers were impatient. They asked us what to do, and why was the algo also on holiday during the month of August and was not producing any signals. So I was looking at trying to understand and reconsidering the probability of distribution, and looking at correlation between the bond market and the equity market, and trying to understand what was happening. And in order to understand today's market and this new paradigm, I decided to borrow a concept from quantum mechanics, which is partial destructive interference, which I think this is what's happening between today's between bonds and equity. If you look at on the left side of the screen, if you look at the 2008 crisis, and you look at for example, there could be the momentum of the three lines could be the momentum of the equity and the bond market rally or crash. In classical mechanics, in this case, there is no interference between the bond and the stock market, simply because there is negative correlation between the two. The bond market is going up in price and the stock market is going down. So the sum of the curves is simply a simple mathematical sum, where if you see that the red line is the bond market momentum, and the blue line is the equity market momentum, the sum of the two is simply a linear sum. Why is that? Because as people move out of the equity market, because the equity market is falling, you will see a simple mathematical acceleration of the downfall of the equity market, because there is a transfer of assets between the equity market and the bond market, because bond market in 2008 was going up in price. So people saw bonds as more attractive, and that accelerated the downward move. And that's why we had a crash of over 50% in the equity market. In today's world, where it's 60-40% allocation in the equity portfolio and bond is not working, you have this concept borrowed from quantum mechanics of partial destructive interference. So therefore, the momentum of the equity market is not being accelerated. So it's not a simple sum, because the bond market is actually falling. So you have two markets which are usually negative correlated, which are now positive correlated. So the equity market is not selling off more because of the bond option, because of the bond market, actually selling off less, because people are not buying bonds, they're not moving out of the equity market to buy bonds, because bonds are also falling. So there is a destructive interference in the momentum of the two markets, because there is somehow a dampening of the volatility on both. That's why we haven't seen in 2022 spikes of the VIX up to like 50, 70 or 60, 70% on the S&P. But the VIX spikes were about 37, 35, and so on. So on the right side of the screen, you see how basically if the equity momentum is the gold line and the bond momentum is the blue line, you see that basically there is an interference between the two momentum and the let's say that the average is actually low. So you have a phenomenon where volatility is reduced because of both market falling at the same time, which is counterintuitive, but never, but in a way is because people in a way should panic more and say, "Oh my God, everything is falling. We should sell more." And actually, no, everything is falling. So I better stay where I am. As if you have two different floors, and you know that your equity floor is going to go down, and so you think, okay, I'm going to jump on the bond floor, but the bond floor is also going down. So you actually stay where you are. So I was analyzing all this. This was going through my mind in August, and at the same time we were seeing an 18% rally on the S&P. The VIX was below 20%, and the S&P was flirting with its 200-day moving average. I knew that some investors, some institutional investors, were buying protection because the VIX was very low, and it had been so low also in April of 2022. And I was trying to think, well, maybe I should take advantage of the low vol and of the insurance premium that was relatively low to buy protection, and that could be in an absence of a red boom, because the market, based on my algorithm, was not overbought. We could consider buying protections so that we could take advantage if the rally would have continued, um, by just losing the premium on the option, but at the same time, if we would have seen a reversal of the 18% rally on the S&P, we would have protected the portfolio. So I was looking at 30 days puts with a strike of 4,000 on the S&P, and they were trading at about 50 basis point, 0.5%. So VIX was in mid-September was very low, about 20%, and previously when it was at 20% in April, it had a huge spike up to almost 37%. So it was a good time to buy because VIX was low, the volatility on the S&P was low, and therefore options were cheap. As I said before, S&P was flirting with the 200-day moving average you can see here. So although there was no red boom, that the low VIX flirting with the 200-day moving average, this new phenomenon of where the bond market did not allow the equity market to fall too much so that the VIX would have gone to 50, but on the other hand also was creating like a cap of the equity market, because when the equity market rallied, also the bond market in terms of price was going higher. So therefore there was also no alternative on the way up. So no alternative on the way down and no alternative to the way up. So therefore, I was thinking that investor would have sold this rally eventually. So on August 17, I sent this email and explaining our subscribers that S&P had 650 points rally from the bottom, 18%, that I was looking at cheap volatility, to buy cheap volatility and insurance. September usually is a bad month historically. Less than it loses. I mean, the difference between September and other months is from the mean is about 7.5% on the downside. So therefore, I thought that spending 0.5% premium, $20 on an S&P put strike 4,000 with 30 days of time value was very, very cheap insurance. So what happened? We all know the S&P dropped about 8-9% in just a few weeks, and although I wasn't sure when we bought the option how big was going to be the correction. Nevertheless, this option strategy would have allowed us to take advantage of the convexity, and therefore the non-linear relationship between the underlying um, price, I mean the S&P price, and the option value. So we would have seen an explosion of the premium and therefore a huge profit on the premium that we bought for $20. And in fact, our option that we bought mid-September was traded from $20 to 150, which was a 650% move, while the underlying asset, the S&P, dropped only 10%. We weren't back then. We were not sure whether the S&P would have reached from 4,300 4,000, but where there was the strike of our put option. But nevertheless, because of convexity, it didn't really matter to us. And then to complete this presentation, and then we'll talk about market outlook. We had a lot of subscriber asking us about what's the optimal allocation during inflation for an investment portfolio. So we looked at the 60-40 allocation historically, and you can see from the graph the blue line between year 1910 and 1930, the portfolio, the best portfolio allocation would have been 100% allocation in equity. Then between the 30 and the 50, you can see here in the graph how it drops, and therefore you would have been better off with 100% portfolio allocation in bonds. And between the 50s and the 80s, also equity would have done better, although there were years where, because of inflation, you would have been better off to have less equity exposures, and sometimes zero equity exposures. So where does this 60-40% allocation between equities and bonds come from? It's the black line here. Actually, to tell you the truth, nobody knows where it comes from. But you can see how historically the allocation has performed in this graph. And some people say, well, let's just draw a line in the middle. This slide was produced by Goldman Sachs using Bloomberg and data stream, and it's only maybe a couple of days old. Another interesting slide that helps us to understand what's the optimal portfolio allocation when there is inflation is this slide where we have basically the correlation. We can see the correlation between the bonds and the 10-year bond and the S&P 500. The blue line is the 10-year correlation, while the darker blue or black line is the 1-year correlation. And as you see that after 2020, you had before you had the negative correlation between bonds and S&P, and now the 10-year, and now we're actually having is moving up. Both the 1-year and 10-year correlation means that correlation is becoming is moving towards positive territory. So both bonds and equity perform the same way. On this third slide, to understand the optimal asset allocation, you can see the 12 months peak to trough losses in US stocks and treasuries. And you can see here on the right side how after 2020, a 60-40 portfolio is down about 20% this year. So what to do? Goldman Sachs and other investment firm think that when the CPI moves higher, for example, in the 70s, that's the blue line, you can see how a real estate portfolio is doing better than a 60-40 portfolio allocation. in between bonds and equity. So ultimately, in high inflation, you should perhaps have a 30% in bond, 30% in equities, and 30% in real asset or real estate.